Walgreens Boots Alliance, ticker symbol WBA, reported their first quarter results. We'll come in here, take a look at the fundamentals, the financials, and as always, jump into the technicals and see why this stock, I think, remains uninvestable for the near future. As always, if you're new to the channel and find this type of content valuable, be sure to hit that like and subscribe button below. Shares of Walgreens down nearly 5% in the trade, as they were down as much as 10% at one point over the past 1 year. This stock is down over 35%, and over the last 5 or 10 years, you would have been better off keeping your money underneath your mattress. Now, first quarter revenues coming in at $36.7 billion. That was good for 10% growth year over year for that top line. That was a beat of nearly $1.6 billion. And then bottom line EPS coming in at 66 cents. That was roughly in line with Wall Street estimates. Now, the big reason why the stock is selling off so sharply, in my opinion, is due to that dividend cut of nearly 48%. Now that quarterly dividend coming at 25 cents a share. And so here on Seeking Alpha, you see this dividend rate still at 7.5%, likely in the next few days. This will get updated now down to, I'm guessing, 4%. And then your dividend rate on a forward basis will come in at $1 per share on an annualized basis. And so that dividend cut, really not surprising over at Walgreens. 2 months ago, we covered the financials for this stock, and that dividend cut was pretty easily foreseeable when you jump into the balance sheet, the financials, which we'll do again in this quarter. And yeah, no surprise that that dividend cut had to happen. In terms of forward outlook, they are still maintaining their fiscal 2024 adjusted EPS guidance, coming in the range of $3.20 to $3.50. They are saying underlying earnings growth will be offset by lower sale and leaseback contribution, higher tax rate, and lower COVID contribution. They are also maintaining U.S. healthcare adjusted EBITDA to come in at break even. And so with an EPS guidance of $3.20 to $3.50, Wall Street estimates are basically at the midpoint of that at $3.33. That would imply EPS decline of nearly 16.5% on a year-over-year basis. That brings your forward priced earnings at just under 8 times. And so when you see a forward priced earnings underneath 10, I think you have to realize sometimes a lower priced earnings is absolutely justified. And that's exactly the case here with Walgreens. With a lower priced earnings, yeah, that's okay because you have negative earnings growth, nearly 16.5%. Certainly, sometimes you see a low price earnings with a fast growing company or even like a decently growing company. And at that point, I think you are more likely to see a undervalued stock. Here with Walgreens right now, you have a price to earnings that I think suits the growth of this company just fine, considering that negative earnings growth of nearly 16%. You also have top line growth, basically just keeping up with inflation at 3.5% to 4% over the next 2 years. And so again, you have this company posting declining earnings for really over the past 2 years, and that will certainly take a hit on their balance sheet, cash flows, and again, a big reason for this dividend cut that was announced in this quarter. Now, in terms of segment sales, US retail pharmacy sales, this is the majority of their business at $28.9 billion. In this most recent quarter, sales grew at 6.4%. But again, the issue with this business right now is gross profits are declining at 7% year over year. And then you have declining operating income and declining operating margins. So while this makes up the majority of their top line sales, which is growing still at a fairly decent clip, but you have declining operating incomes and declining operating margins. And so that certainly is not good to see on their largest business segment. In terms of US pharmacy, again, you saw 10.7% growth year over year on that side. In terms of their international side of their business, this actually looks pretty bright, but it makes up a very small portion of their top line revenues at just $5.8 billion, growth of 4.4% year over year. You have expanding gross profits and expanding gross operating margins, And so this part of their business does look fairly strong still, but makes up such a small part that it doesn't really move the needle over at Walgreens. And then lastly, their US healthcare business, this is the part where they're heavily investing in and seeing very good growth on, but again, similar to their international side, a much smaller part of their business at just under $2 billion on sales, growing very rapidly, but still not really making a profit from an operating basis. And then you have negative adjusted EBITDA for this business segment. This is the part where they've done a lot of recent acquisitions in Village MD, CareCentrix, and Shields. And so they're really trying to grow their US healthcare side of the business. And that's exactly what they're hoping to break even at some point in this year from just an adjusted EBITDA margin. And so while it makes up a small portion of their business, still losing money, this is really where the growth for Walgreens is coming from. Now moving on to their statement of income, you have top line sales coming in at $36.7 billion. That was growth of 10%. Cost of sales rising roughly in line with that. And so your gross profits actually declining on a year-over-year basis, down from 6.95 billion, now down to 6.77 billion. The SG&A cost over at Walgreens still continues to remain higher than their gross profits, and so they're continuing to make an operating loss. This is such a mature company, and for honestly such a mature business to still not generate an operating profit is frankly very disappointing. As an investor, if I'm looking to invest here in Walgreens, I would come down to their operating loss, and this is pretty much where I would stop. Knowing how mature and frankly how old this business is, and seeing that they're still generating an operating loss and have been for really over the past 1 to 2 years, it just doesn't seem like a business where my capital would have the chance to really appreciate. In terms of a net loss, that is again coming in at negative $278 million. Last year, you were at nearly $3.8 billion worth of a net loss, but last year you also had a massive SG&A cost, likely due to a one-time expense. And so year over year, you could see that this net loss on a diluted per share basis has come down significantly. But again, those SG&A costs remain higher than your gross profits. And so with negative operating income, not really something you would like to see over at Walgreens. And so with a negative net income, they don't have a ton of money to really do anything. You see weighted shares outstanding flat year over year. So Walgreens not really being able to do a buyback, can't return capital to the shareholder in that sense. In terms of their balance sheet, that also needs a lot of help. You see current assets, cash equivalents sitting at just under $800 million. This is on a quarter over quarter picture. And so from a quarter ago, not really much has changed. Total current assets coming in at $17.3 billion. That is less than their total current liabilities at well over $26 billion. And so from a current ratio perspective, this company is not in a good position, having more current liabilities in the next 12 months than assets. From a short-term debt perspective, again, $1.6 billion worth of short-term debt maturing in the next 12 months. They have roughly just half of that in cash and cash equivalents. And so again, Walgreens struggling from a debt perspective. You still have long-term debt at over $7.5 billion. That has come down on a quarter-over-quarter basis, but still far in excess of what we would like to see at a company, generating a loss from an operating and net income basis. Moving down to the cash flows, we have that net loss of $278 million. And then with that, they don't really have a ton that they can do. They have net cash provided by operating activities at, again, negative $280 million. So from a operating basis, the cash flows are still negative. Last year, you see they eked out a $500 million operating cash flow gain, but that was due to an addition of nearly $6.5 billion of accrued litigation obligations. This is from generally accepted accounting principles. In my opinion, this really shouldn't get added back onto their cash flows for last year. And so last year, their cash flows from an operating side was far lower at, I'm guessing, close to negative $5.5 to $6 billion. And so that really leaves them no money to provide in investing activities, as they can't really spend on that. They aren't really paying down a ton of debt, as they reissued basically the same amount of debt that they paid down. I'm guessing just refinance that. They aren't able to do a buyback on their common stock, even with shares down 35% over the past 1 year. And then we have this $400 million of cash dividends over the next few quarters that will dwindle down to just $200 million, as they've slashed their dividend by nearly 50%. And so they'll have an additional $200 million from this to continue to maybe pay back some debt or just bolster onto their balance sheet as cash. And so cash and cash equivalents at the end of this period coming in at $850 million. Last year, you were at $4.3 billion. So this company is still in a very delicate position from a cash side on their balance sheet. They don't have a lot of cash and still have a ton of liabilities to pay off. Moving on to the technicals, this one is basically locked in a downtrend, has been for the past, we could call it 3 years now, as we head into 2024. Did look like it was recovering near the end of December, but seems like these earnings and really the dividend cut will continue to send the stock lower in the foreseeable future. Really, you can stretch this back over 5 years and you can draw this trend line however you want to. It really doesn't paint a pretty picture. I think both from a technical and fundamental analysis, this company really doesn't seem investable at this point, or really will be, I think, in 2024. Considering earnings are continuing to decline at a double-digit clip, and then we really have to wait and see if they're really able to put up earnings growth of 10%. And keep in mind, earnings growth of 10% will really just bring you back to the earnings they had in 2022 and 2023. And so really on a 5-year basis, the earnings aren't really growing. And then again, from a technical perspective, has been locked in a downtrend. Even if this does come up here and break above this downtrend, I think there's no real reason to step in and buy shares of Walgreens, considering how delicate the stock looks from its balance sheet. And while they are doing cost cuts, they have announced this dividend cut. They are also cutting back on their workforce and doing more cost cuts. I think time is still needed for this to play out. I think it's fair to say this company will continue to struggle really for the next 1 to 2 years. And now with the dividend cut, you have the last of your investors that were holding onto the stock for this dividend. Yeah, they are probably now heading for the exits. So there's no real reason to come in here and pick up the stock with such poor fundamentals and such poor technicals. That was my take on Walgreens Boots Alliance. The new management certainly has a ton of work to do, and I'm really not buying into the stock until I see the effects of that work show up on their financials. Let me know your thoughts on this stock, whether you're coming in here and buying shares after this dip or not. Thanks for listening as always, and I'll catch you guys in the next video.